We all see the stats today that Figma has this hyper growth and best-in-class margins. What operational choices do you think along the way made that possible?
What AI has done is it's changed my frame a little bit, because if you believe that AI is almost this massive democratization layer of who can now participate in the product development process, your TAM just increased multiple fold.
You as a CFO are reflecting on the admin's life cycle of having to play good cop or bad cop with approving the licenses.
What I've been able to do is be engaged in some of these sales conversations when you appreciate the pain. Ultimately, your customer is your North Star, and you got to really make sure that you got something that's defensible in front of them, because you don't want that sentiment to shift and change, especially if the community aspects of what you've built are so core to your future success.
I want to talk about the IPO for a little bit. The stock kept going up and up and up. What was going through your head?
I didn't really have a lot of time to think at that moment in time. And what we were more focused on was how do we get back in front of our employees to have them understand that regardless of what the stock does, nothing has changed. We are still the same company that we're at. The stock market's going to be a short-term voting machine, a long-term weighing machine.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the show where we talk with the world's top CFOs and finance leaders. I'm CJ at Tech CFO, and my goal is to unpack the frameworks and operating principles that make you better at allocating capital and leading teams. On today's show, I'm joined by the CFO of Figma, Praveer Melwani. He joined the company when it was a 30-person team, and he was fresh off being laid off from his previous role. He went on to help scale Figma into one of the most iconic software companies of the last decade, culminating in one of the biggest IPOs in recent years. In this episode, we go deep on the journey from IC to IPO CFO, the inflection points, moments of uncertainty, and how you grow into a role faster than you might feel ready for, forecasting and monetizing product-led growth, how Figma thinks about expansion, LTV to CAC, and predicting revenue when usage spreads organically across an organization, and the reality of going public, what IPO day actually feels like, how pricing decisions get made, and the tension between company, employees, and the banks running the process. We also get into Figma's approach to pricing in the age of AI, how to think about TAM when your users don't fit in a clean box, and the internal metrics that drive both growth and profitability. If you like the show, please remember to like and subscribe. It helps us with the algorithmic overlords. And if you're looking to hire the best finance and accounting talent, I'd love to help. I run a recruiting service that pairs you with thoughtful, qualified candidates from our community of finance leaders. People who, for better or worse, voluntarily research CAC payback period formulas on weekends. If that's of interest, shoot me an email at talent@mostlymetrics.com and we can talk. On to today's episode with Praveer. Praveer, thank you so much for joining me on the podcast.
Lovely to be here. Thanks for having me.
So I just want to set the scene for people, because when you started at Figma, you were an IC and there were maybe 30 people working there. I think I actually heard on another podcast that you were unfortunately laid off from the previous role you're at. Now you were a part of the largest and most publicized IPO of 2025. It's quite the come up. It's something they don't make many movies about CFOs as much as I would watch them, but that would be the plot of a great CFO movie. Break it down for me.
I used to tell a joke to someone, or one of my two truths and a lie was I've been walked out of 2 of the last 3 jobs. First one was in banking when, I told them I was going to Dropbox, rather than letting me sit around. It made me pack my things and walk through the whole hallway, which was fun. And then the second one, I actually, walked out on my own 2 feet at Dropbox. And then when I was at NerdWallet, lasted about 6 months, realized that, just I wasn't necessarily finding the right fit of things. And when they went through a little bit of the change on the leadership side, it kind of alienated a few of us on the business side and gave me an opportunity for the first time in my career to say, okay, what are the things that I'm really excited about? What are the companies that are really damn interesting? And I went to a bunch of my friends that ended up in venture, and I got lucky that one of the companies I ended up talking to was Figma, and it was just this perfect blend of they had no idea what they needed, gave me all the autonomy to go and figure it out. I was just really, really drawn into this idea that if you really believe that the digital front door is going to be the thing that matters to organizations, you want to be at a company that's building, a collaborative interface around, how people make decisions on, what those great products look like. And, they had been really, really thoughtful to spend the time building a really unique interface here at Figma that was, it was about 4 years, heads down building before they had something out there. What I started to see early on was just that folks were really excited about this. You had really large organizations that were willing to put their hand up and say, hey, hell yeah. And that was enough for me to say, hey, if some of these large organizations are excited, I can figure it out and it'll be a fun ride either way.
Were there any memorable inflection points along the way that come to mind? Times maybe that you got to prove yourself by taking on more? You mentioned Figma maybe didn't totally know what they needed at that point, or times where you were actually unsure of yourself and just stepped up anyways.
Yeah, I'm someone who just will whip my hand up to do anything. I was about 26, 27 when I joined Figma, and I didn't really have an ego. And so I was willing to, I still don't have an ego. So I'm still willing to at the time it was like building a lot of our financial infrastructure so that I could do a lot of the basic querying and build all the connective tissue necessary in order to get our close process done right. And, I just got excited by that kind of stuff. And I realized that those micro decisions I was making that, throw my hand up and just execute was providing these opportunities to learn the business really quickly. And then when you ended up in these situations where you're like, hey, let's figure out, our enterprise pricing or like our go-to-market efforts, like someone who had the context of what this all looked like was going to be the person that, everyone was going to have to go and come and ask questions to. And so that was my wedge. And then about a year into being at Figma, we had originally had a COO at the time when I joined. And about a year into me being there, he ended up leaving. And it just created this like massive amount of white space. And I was like, okay, well, who's going to figure out legal? Who's going to figure out compliance? Who's going to figure out like how we actually, think about our sales ops and strategy pieces? And it was the first time that Dylan, our CEO, I had a discussion with him. I was like, I'm down to try. I might not know how to do it perfectly, but I'm going to ask the right questions, and I'll talk to all the different people in my network, and we'll figure it out. And I've been fortunate to be empowered to to go and hire great people, be able to learn from them along the way. And my role is like, how do I ask the right questions of them to get the right answers, but then also just get out of their way at the right times in order to go and build. So everything from hiring our first legal person, who today is our GC, to building out like an accounting organization. And, most recently over the past year, it's been like, how do I, put my arms around the CIO function? So that's a team that, it's been fun to learn about, to build. I'm actually hiring a leader right now. So it'll be fun to continue to professionalize that in the years to come.
It's wild because at many tech companies, the growth of the company outpaces how fast an individual can grow. So it's really refreshing to hear. And by the way, you were growing very fast at the time, that you were able to personally keep up with that. And it sounded like it was just a series of putting your hand up over and over again to build trust and credibility with Dylan and others.
Maybe this is like not completely fair, but I don't actually think a lot of the things that people have to deal with day to day are incredibly hard. I think that it does require first principles thinking, though, and an ability to know where you need to go and ask for help. If you get stuck in your way of doing something, actually having all that legacy of historical decisions can slow you down. And so I actually kind of view that as a strength for me, is I just didn't know any better. And I still feel like I'm, on my growth edge quite a bit, because, a lot of this stuff we're building for the first time, we just don't know the answer to. And so you can go and ask questions of others, build your own intuition, and then recognize that it's not going to be perfect. And you only really need to be perfect on those one-way door decisions. The rest of them, like, it's okay to be wrong. It's okay to iterate, and being comfortable along that lines is what I think releases the pressure to go and execute.
I love the concept of one-way and two-way doors. You talk about that on the pod a lot. We talked about your personal growth. I want to talk about Figma's market growth and TAM expansion. We're going to hit on the company in the micro, but I'm just curious, as a CFO, how do you think about TAM? Is that something that actually impacts the way you look at your operating model, or is it more of an investor view of the world?
Measuring your TAM at any one moment in time is always going to be wrong. Famously, Dylan talks about it when people were doing the math and trying to figure out what Figma's TAM was. They went and surveyed, all the different folks that, today or at the time were engaging in UX and UI jobs. And, I want to say it was like 200,000-300,000 or something like that. Individuals. And, that was just entirely wrong, because the way to frame the problem was not, how many current people with that job title are doing that work, but rather instead, like, how will, the responsibilities of individuals evolve if digital experience is a company's front door? And if that's then true, everyone's going to want to participate in that process. Everyone from, your legal person who wants to go and edit the copy on a sign up flow, your finance person who wants to go and review the pricing page, your developers and your PMs, all of who want to participate in the ideation and product building process themselves. So if you think about, your TAM by virtue of here's the specific role types today, and you put people in buckets, like it's actually limiting in, the ability to really think broad on how big things can get. And, that for me is one of the larger learning experiences I've had here at Figma is like over time, we continue to find ways to redefine and reinvent ourselves. And we found ways to take to market offerings that allow us to, serve our growing set of users in first-class ways for their particular needs. So, what maybe it started for that core design persona and design ops individuals, now something that all parts of, your development team will have a need in Figma as they're trying to translate designs into code. And then similarly, your PMs who can use a product like Figma Make to prompt and prototype an idea relatively quickly without necessarily leaning on a designer and developer as their hand, the TAM is now continuing to just multiply.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
Scaling a tech company is thrilling. It's also really, really messy. Just ask anyone who's done it, or anyone who's tried. Better yet, ask EY. They've seen startups at their best, and in their most fragile moments. EY knows you don't start a company to burn cycles on regulatory hoops, discounted cash flows, or the fine print of SEC Form S1. Although you probably do know I love myself a good S1 if you've listened to or read my stuff long enough. You can't ignore these things. That's how risk compounds. Kind of like negative interest. What you can do is work with EY from day one. They'll help you get it right early and often, so you can stay in builder mode and keep the trains running on time. EY, shape the future with confidence. Learn more at ey.com/tech startups. That is ey.com/tech startups. Let me ask you something. If your board wants financials, would you be certain you're not wasting money on SaaS? Or if a major renewal hits, would you know if you're paying a fair price? Your vendors would see thousands of deals per year, but most finance and procurement teams see one deal at a time. That's a tough way to negotiate. SpendHound fixes that intelligence gap. It's one place to track all your software spend and gives you pricing benchmarks across more than 10,000 SaaS and AI vendors. And it's based on real spend data from over 8,000 companies. SpendHound connects to your financial systems and shows every software dollar you're spending. Contracts, renewal dates, overlapping tools. Nothing quietly auto-renews, and you don't pay twice for duplicate tools. SpendHound is the #1 rated SaaS spend management platform on G2. It's trusted by teams at ZoomInfo, Hootsuite, and Kit. Free forever, wow, for SMB and only $10,000 per year for enterprise with $150,000 savings guaranteed. If you want to stop negotiating blind, go to spendhound.com. That is spendhound.com, trusted by over 1,000 finance, ops, and procurement teams. If you're paying for A-level finance talent, they shouldn't be doing B-level tasks. CFO time is expensive. Senior finance hires are wicked expensive. And yet, in many companies, highly paid operators still spend hours reviewing expenses, chasing receipts, and reconciling systems that should already be automated. That's where Brex comes in. Brex is an intelligent finance platform that combines corporate cards with built-in expense management and AI agents that automate the repetitive work finance teams usually handle manually. Transactions are categorized automatically. Receipts are matched. Policies are enforced in real time. Reconciliation just runs in the background. So instead of adding admin as you grow, you increase output per finance hire. Brex is already automating hundreds of thousands of hours of manual finance work every month across 35,000 companies, including Anthropic, Coinbase, and DoorDash. If you want your finance team focused on performance instead of paperwork, check out brex.com/metrics. That is brex.com/metrics. So one stat that jumped out when I was flipping through the S1 is that about 2/3 of Figma's users are not designers. I'm curious, from a finance perspective, does that make forecasting harder or actually easier?
So for me, it hasn't made the forecasting process harder. I actually don't really think about it that much. I do think about it as an opportunity, in the same vein I was describing the TAM, when you really think about like, where is your true white space? What is the opportunity to go big here? And if you really believe that, we have a solution that's going to be purpose-built for many more users than just the core design audience, then that should give you an opportunity to believe that you can continue to grow durably at scale for some time. So, that has been our focus, and that's kind of how I use that information. And I think maybe at times the other ways that I leverage it and I use it is when I think about different seat types, because there are different landing spots at times for different sets of end users. But outside of it, I actually view it as a strength to collect that information, to understand different job types and personas so that we can build unique forecasting models and checks along the way.
So I guess it's somewhat of a related question about forecasting. Product-led growth companies, they don't have the same pipeline predictability, some would argue at least, is sales-led SaaS. As a CFO, how do you forecast growth when the adoption spreads organically inside of companies? Maybe it's a blessing and a blessing, not a blessing and a curse.
Yeah, if anything, it gives me way more information. I mean, when I think about any one of our sales accounts and the opportunities that we've got over there, they most of those users have started with small pro teams or on starter plans. What actually is happening is our sales processes end up being much more quicker as a result, because there's already an engaged understanding and a champion that we've identified. So I actually use that to help me size an opportunity, to understand where is a relevant landing spot, and then ultimately using a lot of the in product information to understand how quickly this account will grow. So you think about, okay, how quickly are files being shared back and forth? How quickly are new signups being added? What does the adoption of new products look like? And so, we very much still measure and manage our business through an understanding of the core product adoption. And then if you think about on the self-serve side, it's very similar. So, we offer the ability to both purchase our pro product via self-serve offering as well as our organization's product. And it's a very predictable funnel for us. So, a user signs up, they hit a certain paywall at a certain point. This is what conversion looks like. And you can kind of build a fairly clean cohorted chart that obviously is going to continue to change as you roll out new products in different geographies, that sort of thing. But I kind of love it. It's like, it's a data person's dream, and you can build some really unique ways to forecast your business as a result.
You mentioned building out ways to track pipeline and user activity when you first started at Figma. Were you nerding out on the cohorts from the very beginning?
Yeah, it was like the first thing I built. And, I think it was like month 3. I'm like, oh my God, net dollar retention is what? Because we were landing people at like 4 or 5 users a team, and they were over the first 3 months ending up at like 15, 16 folks. I'm like, holy shit, like we're like literally tripling the size of these accounts, and no one is really dropping. Like, we raised our Series B within like 2 or 3 months of me being there. And it was that cohort chart plus the net dollar retention chart. We had like a smile graph that effectively like maps out over a 28-day period someone actually using the product. And for folks that were paid and using it for work, you saw this real smile start to emerge. And we're like, oh my gosh, we've got something here that's really, really interesting and resonating. And I think on the back of probably just those 2 key metrics was what Mamoon and Kleiner got really excited about. That like sparked this whole sort of rabbit hole for me on like trying to understand, more thoughtfully what else we could be doing to really catch a handle on it. And the next thing that we did was add in a sales touch model to it, because we were realizing and getting pulled into the large enterprise very quickly.
How do you think about the economic value of that very first seat?
I think given how quickly that we've shown an ability to expand our product portfolio and who's potentially addressable to Figma, I don't actually think that we know what our long-term LTV will be. It's a growing number is maybe my point.
That's such a refreshing take. I often say I pray for the confidence of a seed founder with 3 months of sales history that claims their LTV to CAC is 9.
Yeah, I don't think people understand their LTV at the very beginning. You can control for like payback if you're really concerned about spend and paid marketing. We didn't run any paid marketing at the beginning because the product was so viral. The value of that first individual in seat for me, what I would do every morning, actually like would print out who are accounts anywhere that signed up, who came from a domain that I can recognize. And then we would very quickly say, oh my gosh, like someone from Microsoft or Uber or Airbnb, whatever it was, they signed up. Like, let's just make sure that their salesperson is reaching out for them. And so I think it would depend on the scoring that we had created on the value of that incremental sign up or dollar. And you can develop a lot more refined ways of thinking about it as you start to develop more insight and understanding. But I don't think that I, at least today, understand what my long-term LTV of a particular customer will be. If anything, though, what I get excited about is that we've shown an ability to grow our share of wallet time and time again. And so, if we're aligned in building great product for end users that they absolutely love, like we'll find an ability to build a great business. And we've proven that time and time again.
We often talk about the financial signals around an account. What maybe product signals you as a CFO actually hone in on that tell you, hey, this account, I think it's going to explode in usage?
We spend a lot of time looking at, sharing and virality, like how quickly are new users getting added to the platform? How active are those users? What products are they using? How many of them are using multiple products? Back to your point on like having access to all this data, you can make some really interesting damn predictions just by sheer understanding of how people are using the various parts of your product and getting into like happy end states. Now it's actually, a lot more fun because you layer in the AI features and credits as well. And so, you have the ability to understand where are people starting, if it's in Figma Make, how are they then taking that idea into Figma design, what we've actually seen is 80% of the folks that are active on full seats actually also go and are active on design. So both of those products are used side by side. For us, it starts to get like really fun to understand that like if these users are really using and seeing the value of the full platform, that should drive, more stickiness as a result. And, that I think is probably one of the things that if you're really concerned about LTV, should be the thing that, allows you to extend your LTV. You're just having very, very minimal churn long term.
So you've been there for a while. I'm curious, when you look back, I mean, we all see the stats today that Figma has this unusual and awesome combination of hypergrowth and best-in-class margins. What operational choices do you think along the way made that possible?
I mean, I think there's like a few principles that we have. Like a lot of this also stems from Dylan's way of running the company. Like I think he's like really, really thoughtful to seek to understand all parts of the organization. And so it's really difficult at Figma to build teams that, you aren't able to articulate the value of. We are really, really diligent to go and make sure that each individual that we're hiring, we understand exactly why, we understand exactly what they would work on. And then that also means that you also want to be really good at performance management. So if the folks that you've hired are not kind of living up to the expectation that you would have hoped, like quickly nip that in the bud and ensure that it doesn't, start to fester. Because I think that, worst thing that could happen in an earlier stage company is if you start to have these pockets of, not so great talent density, because that just is going to start to be a drag on the business, for a while. But beyond that, the core business itself, prior to the launch of a bunch of our AI features, we should talk about the AI features as well. It is highly efficient. We're basically storing vector drawings and diagrams, so the storage cost is relatively minimal. And I come from a background of working at Dropbox, so I've seen the costs. It's very refreshing to see, what our AWS bill look like. And then on top of that, it's the compute. I mean, the compute was, it's the compute and being able to serve the multiplier instance. And we've been able to do that in really thoughtful ways. And I think our infra team is pretty amazing. And so then you put those together, and if you're running the core business prior to the, if you looked at, the business in Q1 of last year prior to, rolling out our AI features, we were like 91-ish% gross margin. And so what that allowed us to do is to say, okay, well, you don't actually have to have this massive stack of OpEx beyond that. And then you're able to run the business free cash flow positive for some time now. And so then that becomes this like, reinforcing principle of like, we know that we have the ability to be efficient. Let's also just make sure that we're making intentional decisions on the hiring side and then really scrutinizing, every dollar that comes in. I think what AI has done is like, it's kind of changed my frame a little bit, because if you believe that AI is almost this massive democratization layer of who can now participate in the product development process, your TAM just increased multiple fold. What we aligned on as a leadership team is like, now is the time for us to hit the gas and invest. Because if we believe that we have the opportunity to go very wide within our organizations, or within the organizations that we're serving today, much more wide even than we currently are serving today, then we should trade that near-term efficiency dollar for long-term durable growth. And so that's kind of exactly what we've done. We've taken down our gross margins over the course of the last 6 months. So we exited at about 86% gross margin at the end of Q4, and that's because we were serving the cost of inference to power some of our newer products and features. We'll start to monetize those features actually tomorrow, which will be fun to see. But, we really wanted to make sure that we gave ourselves an opportunity there to go wide. And I think that, we want to give ourselves the flexibility moving forward and have this social contract with our investors that if we find that opportunity to invest for the long term, we'll take it.
You teed me up so nicely there, because I want to talk about pricing, especially with AI being front and center. Praveer, what gave you the confidence to launch an AI credit model?
Without it, you're sitting in a challenged place, because, we talked a little bit about the cost to serve. The cost to serve these AI products is, it's non-trivial. If you don't have the ability to align your model to one where it makes sense to drive more utilization on platform, and that's actually good for the business, like you're going to end up making these weird local decisions. Like, do I actually want people to use my AI products or not? Like that just doesn't feel right. If you made the intentional decision that, it's important for us to have a play here, you want to make sure that you're aligning your cost structure with a value structure that makes sense, a revenue model that makes sense. I think today everyone is more aligned on these consumption models that, they're not perfect tokens in as dollars out, but they're kind of stemming in that direction where because these models are dynamic in their outputs, you don't actually know what you're going to get every time that you're going to put something in. They're indeterministic just by nature. You do need to have something that allows you to have a varying sort of revenue model and credit drawdown model as a result. So it was kind of a no-brainer, but then you end up having to race to see, okay, well, what is the best way to implement that? For us, we have this product-led freemium type model, Roots, and we recognize that giving people some opportunity to try our AI features by embedding a set of AI credits across all of our seat types was extremely important to us, because you're really going to know that not going to experience the magic unless you try. But then also, if you're using the product in more mature ways, we want to give ourselves an opportunity to monetize some of that as well.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
I've seen a lot of FP&A tools, and Aleph is one of the few that gave me that aha moment within minutes. I remember watching their founder, shout out to Albert, connect my NetSuite data and build me a full P&L live in minutes. Aleph is now trusted by hundreds of leading companies. I've had the CFOs from Turo, 8 Sleep, Zapier, and more on the pod, and every one of them is a huge advocate. I also just published my second annual CFO Tech Stack report, and Aleph has been on the podium both years, including a #1 finish in the $50 to $100 million segment this year. Instead of being just another planning tool, they built a real enterprise-grade data foundation for finance, implemented at startup speed with AI-native workflows woven into its DNA. All your systems, ERP, CRM, HRIS, ATS, product usage, and more, powering one clean, governed data layer that finance can actually trust. And with AI moving as fast as it is, they're pushing even further. MCP, custom AI chatbots, AI-powered variance analysis, and the list keeps growing. Try it with your own data at getaleph.com/run. That is GETALEPH.com/run. Tell them CJ sent you. So here's a pattern I keep running into when I talk to finance leaders at fast-growing companies. You've outgrown the spreadsheets. You've probably outgrown your billing tools built in RevRec, but you're not quite at the point where you can throw a 20-person team at the problem either. That's exactly the danger zone RightRev owns. RightRev is revenue recognition done right. It handles the messy stuff like high-volume subscriptions, usage-based contracts, and mid-contract upgrades. The things that break your ERP and the billing platform bolt-ons. Here's the thing though, your sales team isn't slowing down for you. They're closing ramp deals, usage commitments, and mid-quarter upgrades. And the longer you wait to fix the engine, the further behind you fall. So stop scrambling at month end and stitching together allocations across 3, 4, 5 spreadsheets to just have the numbers ready. Well, that's it. That's the whole pitch. CFOs tell me it's like a glow up for the revenue books. If that sounds like where you are right now, RightRev is worth the look. Head to rightrev.com/CJ. That's rightrev.com/CJ. Check them out. Being a CFO, you know how much I love tools that actually make the lives of accounting and finance folks easier. One of my favorite tools right now is Rillet, the AI native ERP going head to head with NetSuite. Yes, someone is finally doing it. I met Rillet 2 years ago when they were still in stealth. Since then, they've absolutely taken the finance world by storm. Their mission is to make the zero-day close a reality, and they're actually doing it. Customers are literally closing their books at 1:35 p.m. on the first day of the month. They've got everything you need to scale your business. Complex revenue recognition, native integrations, custom reporting, multi-entity, close management, and much more. They're only a few years in and are already supporting NASDAQ publicly listed companies. Yes, seriously. If you want to scale your business on an ERP that wasn't built in the 90s, you need to check out Rillet. Book a demo at rillet.com/CJ. Oh, cool, that's me. That's RILLET.com/CJ. RILLET.com/CJ. Tell them I sent you there. We recently spoke with Dan Griggs, the CFO of Intercom, and they leaned really hard into outcome-based pricing. I'm curious if you ever thought about potentially going that route.
We thought about it. I don't know we've fully aligned on what that specific outcome would be, because the design process is so iterative. I think, Intercom's it's a much more obvious where you'd end up. There's probably different ways that we could flavor it. I don't think that we've all aligned or seen the light yet on what that would be. I love the idea of thinking of that as a North Star. I'm just not sure that we've identified that.
Where do you think margins ultimately settle for AI credits?
It's a good question. I got this a bunch from investors. For me, I'm less worried about the specific margin percentage. I'm more thinking about like, if you believe that, you're going after a much larger TAM by investing in these AI credits and models, like it should be gross profit accretive. You could be serving more dollars on the top line. Your cost to serve may be higher. I don't actually know the percentage, but I'm confident. I want to be confident that the overall gross profit dollars are growing because that's how you know it's good for your business in some way. I do think that, what that means though is like we'll start to see some efficiency across like our OpEx as well. Obviously our whole team is using, across the company are using a whole variety of different AI tools to augment their own daily output. As they invest in that, what that should mean is we should be able to continue to run our business more efficiently. I think net that should put us in more positive income margin land, over the long term.
I love how you trace it all the way down to benefits for net income, because I come at it from the perspective of an operator, right? I'm a recovering tech CFO myself, so I'm less interested in, gross margin from an investing perspective of buying stock. It's cool to hear how you think about it. Like, hey, it's all connected, right? Like even if you give up some points up here, it should play out in the middle.
I mean, ultimately, companies are valued based off, their ability to generate free cash flow in the future, right? Like I think that's the lens that we all need to be thinking about, like the value that we're creating over here. Like free cash flow per share is almost like the North Star metric that I, want to hold true. I think it takes a little bit to get there, obviously. I always want to be making decisions that, align to that over long term.
That's your metric. If you had to keep one in your pocket, it would be free cash flow per share.
Yeah. I mean, I think like as an investor, it's the way that I think you're thinking about value and, everything all the way through, like, that's ultimately where you're going to land at the end of the day.
We forget sometimes that the main goal of business is to actually make money, right?
The whole point here is it's long-term versus near-term. And I think you're going to end up making different decisions ultimately with that long-term frame in mind. And so, it's not saying that there aren't going to be different things that you want to focus on, in the near term. Right now, we're very focused on growth and ubiquity, but I do want to make sure that, we have an eye towards like how this all kind of makes sense, or at least like a set of theories and plans for how we can kind of get to a much better end state based off the current decisions we're making.
So your net dollar retention rate, it's bonkers. Do you ever worry that toying with the pricing model could introduce more volatility?
We've seen time and time again an ability to inflect this metric. So through the launch of new product, new tiers, and, over the past year, it was both like new product as well as we had a pretty large pricing and packaging change that we made. So, I'm not necessarily worried about the volatility it creates. Again, if I think long-term over here, we should be making decisions that best align for the business over the long term. What I'm most focused on is ensuring that like our customers really feel like they're getting a ton of value and we can figure out the right moments in time to share in that value. And so if that means that, your net dollar retention rate ebbs and flows a bit, like I think that's totally natural, so long as like you're also making sure that you've got a viable path, over the long term where this makes sense.
When you think about pricing more broadly, what do you think is the hardest trade-off? If trying to maximize revenue per seat, I think you kind of hit on that before, how much you're getting per user, or maximizing adoption across the organization, or maybe it's just preserving product simplicity.
I mean, I was actually going to suggest simplicity because like that is one of the things that like we constantly think about. One of the decisions we made last year was to actually move from an unbundled product, like seat model, to a bundled model. We recognized we were shipping a lot of product very quickly. And if you then thought about the admin experience, like we went from 4 to 8 products last year. If you think about like managing, access to 8 products as an admin, like that's just a pain in the ass. So we needed to simplify that. You can make the argument that it may have been value maximizing to have these unbundled seats in certain ways, but like the simplicity of the offering, making sure that like you're making decisions on the pricing side that also like, your buyers challenges, like if administration is annoying, if procurement doesn't love it, like it's just going to start to create these headwinds for you. We also made decisions before where we knew that it was going to create a headwind to our expansion rate, but we did it and we made those changes because it was good for admin trust and visibility, and over the long term we think that it puts us in a more positive light. So we shifted the ability for a user to land in a new product from a user-driven upgrade model to more of an admin, approval model. So the admins still had the ability to review in that old world, but they played like, bad guy at the end of the day, versus like if you pull it up, it allows them to have this sensibility of control. I do think it's a constant push and pull and balance. Like it's like user sentiment. You have to be really thoughtful about brand. I don't think that you ever want to have the value equation shift completely into the company's behalf where it feels like your users don't feel like they're winning here.
I have to give it to you, man. We often talk about on the show the importance of meeting customers where they are and thinking through the customer lifecycle journey. You as a CFO are reflecting on the admin's lifecycle of having to play good cop or bad cop with approving the licenses. So it's really cool to hear that.
I mean, it's actually pretty interesting because I would have argued that the old model that we have, I still kind of stand by it a bunch, but I also recognize that even if it feels like it's net beneficial to your end user, if you can't communicate it well, if you can't like have them really understand and feel like it's good for them, even if it is, like it doesn't matter how good that offering is. They just have, if they don't believe you, they don't believe you.
Well, I've been in that seat before too as a finance person where it actually was with Figma, I think, where we had a bunch of licenses and then suddenly, boom, it exploded. And like, it's like, cool, I'm glad you're getting usage out of this. But like, I kind of have to play bad guy here to make sure like we don't like give everyone in the org a license and it doesn't get used. So that was just like a great tactical story from your end of understanding how the licenses are provisioned. And it's not just the value to the person doing the design work or whatever else they want to do. It's the person who's, signing the check for it.
And I want to be in the place where like, we've built the trust. Being able to grow up with the company, what I've been able to do is like be engaged in some of these sales conversations when you appreciate the pain and you're like, okay, I get it. I have to like broaden my horizon and thinking. And, it's not just whatever my spreadsheets is saying. Like I do think various perspectives matter. And ultimately your customer is your North Star. And you gotta really make sure that you got something that's defensible in front of them because, you don't want that sentiment to shift and change, especially if the community aspects of what you've built are so core to, your future success as well.
I want to talk about the IPO for a little bit. Take me back to the day you went public. The stock kept going up and up and up. What was going through your head?
You don't really have a lot of time to think during that day. It kind of felt like my wedding day, like you get up, you get dressed, there's someone that's like waiting to take you to the exchange and you're bombarded with photos and people telling you where to go. And so even after you ring the bell, you're like back to back on press interviews. And so then you're like, actually have a moment to go and talk to the market maker to really understand, where's the stock going to open. You get like a 2-second response and you're like, your head's spinning, but you don't have a lot of stuff that you can really do to action. You've put all the wheels in motion at that point. And, I think you let the process kind of take care of itself. There are some things that you can control for, but there's a lot that you can. And you just have to make sure that, you're ready to deal with whatever the outcome is.
I totally empathize with you there. And I can also picture you just being like ushered from like interview to interview. Like you're like this widget on this factory line. From a human perspective, did you ever look at your phone and you were just like, I think this is actually going too high?
Again, I didn't really have a lot of time to think at that moment in time. And so, what we were more focused on was like, how do we get back in front of our employees to have them understand that regardless of what the stock does, like nothing has changed. We are still the same company that we were at. Like the stock market's going to be a short-term voting machine, a long-term weighing machine. And what I actually think Dylan did really thoughtfully is like at close that day, he had the ability to go and address the full company, and he never once addressed the stock price. He kind of, addressed the point that, there's going to be these up and down swings, whatever may happen. Like we have to be completely focused on building a generational business. And it's easier said than done. Like a drunk elephant dancing in front of you. You got, it's hard not to stare. But I do also think that, having that principled view of thinking long term was the right one at the time. And, it's one that, I continue to try to reinforce with my team now too.
We've spoken to a lot of the CFOs whose companies have recently went public, CoreWeave, Chime, Navan. And I remember talking to Bill Koefoed of OneStream, and he was saying the biggest change for him day to day is like he'd just be walking around the office and employees are, having a coffee, checking their phone, looking at the stock price. And he's like, I wish I could just take the focus off of that because it's almost like this extra pressure that we put on ourselves. And I know there's a totally like a CFO friendly answer to all of this, but do you think there is any undue pressure to try to keep the stock at perhaps like an unrealistic range for employees, especially with a lockup in the background?
Your mind goes there, but then, the reality also strikes in. And I think the reality of what we had set up and, many of these IPOs that in the way that they're constructed, it's a fairly small amount of the float that's trading. And most folks haven't yet fully, digested and understand your story. You can play all these games with yourself on like, what do you think you're able to do and what you hope you will be able to do. Or you could, not try to fight it and you just again focus on the long term versus trying to play these games of trying to maximize in the moment. Obviously there are things that run through your head. You're like, how do I potentially take advantage of the moment from various sort of capital structure mechanisms and thought. But other than that, like I didn't go through a whole bunch of hoops in my head suggesting otherwise.
It's almost like you don't even have time to go through those things because you got to get back to actually working on the company.
Yeah, I mean, that has always been my focus. It's like, I recognize that being a public company is adding a whole bunch of new priorities and new stakeholders that I need to be really thoughtful of. And I think they're very important. It does end up being a different draw on my time than, what I was working on even, a couple of years ago. And so I want to make sure I'm doing my best and putting my best foot forward, but I also want to make sure that I'm able to get back to the core building pieces. That's the parts I enjoy and love, and I think are very, very important, especially given, the environment that we're living through at the company today.
I've heard you say before that you kind of have, and I don't know if it's a formal thing or informal thing, but kind of like a kitchen cabinet of people that you go to for help with decisions that you're making or things you're going through. I'm guessing you've been to them quite a few times, including the IPO process as a first-time CFO who's also taken a company public. Have you been relying on that board of like personal advisors more to help you?
It's the only thing that's kind of kept me here. You mentioned before, like, the only way that I think I've been able to scale, or I hope I'm scaling with the company, is by virtue of having the opportunity to go and reach out to people who kind of done this before multiple times over. It's such a privilege, honestly. Like, so many of the things that we go through, they're not like first of its kind. And, there's so many different allegories and similar sets of experiences that other people have gone through, and being able to draw upon them and having the benefit of the platform that Figma has given me to learn from them is like something that I just feel so blessed for. I don't take that for granted. And I recognize that, I'm privileged in my position to be able to go and ask those questions. I know that not everyone is going to be able to get that same level of access. What I then keep in my head is like, how do I then return the favor? Many of the things that I've been through in my experience, I can now go and help others with. Early stages of building a team, fundraising, to, going through a sale process of the company and understanding all the fun parts of regulatory, or even now going through the go public process. I very much recognize that I've got a story to tell and help others with as well. And I very much also value the perspectives and help that I've got along the way, and want to return that favor.
This might be a very meta question, and we can strike it if there's no answer there. But I do feel like, at least in my career, I had to get better at how to ask a question to people ahead of me to get like the answer back. Do you think you've gotten better at asking for questions from your advisors so you have actionable stuff to go back and work on?
Yeah, I mean, I love to take like an actual problem versus like a theory of a problem. And I think like if you're able to actually show them and help build context really quickly, by showing that you've thought about the problem really well, I think you're going to get a much better answer and a much better like back and forth. What I don't like to do is to take like open-ended questions like, what would you do in this situation? But it's like more so, let me take you through my frame of thinking and help push back on like, what are the things that you would do differently, or set of context that you'd want to have in order to make the best decision here. So I think like if you brought people these nebulous ways of solving a problem, or open-ended questions, you're not going to get the right answer. And so I think like being crystal clear in how you build that context is important.
Praveer, I'm going to take you into what we call our long ass lightning round. If you could tell your younger self something knowing what you know today, what would you tell them?
Don't think so much. Like, just trust your instinct and you can figure it out. Most people don't know what they're doing anyways.
It is true though. Like, the higher up you get, you notice like people are just kind of like making it up as they go.
I mean, it's my day to day. I do think that you have to trust your instincts. You have to trust your first principles thinking, but there isn't a right answer most of the time. You got to make the most with the information that you've gathered. And some things are going to be the first time that you have to deal with it. And it's okay. Again, to the point on like one-way versus two-way doors, like don't screw up the one-way doors, but like give yourself the freedom to make mistakes along the way. Cause I think speed through hyperscale is like the most important thing that you can probably optimize for.
Next one I got for you. What's the basketball mural you got behind you?
I'm from Toronto. So this is, the 2019 run with Kawhi hitting the shot in the corner. Our house was like white walls everywhere, and it kind of looked like I was sitting in an insane asylum. And so I needed something to stuff.
I got a question that is not nearly as interesting as the last one. Can you walk me through your finance software stack? What tools does your team use to get the job done today?
And we constantly experiment with new things. So, I mean, our ERP is NetSuite. We use like Stripe for a whole bunch of different billing, Zip for procurement. We use Pigment for financial planning. The thing that I'm actually really excited about is like spreadsheets are still my love language, and we spend so much time in them. And I spend a ton of time, still in Hex querying a whole bunch of stuff. But I think you can build some really unique, even forecasting capabilities and methodologies by leveraging tools like, ChatGPT or Claude Code. And even over the last few weeks, like I've been messing around with our finance team on like, what is a better way for us to forecast throughput for a particular model that we need to go and build a capacity model for. I mean, you could do it in Excel, or you could just, build a regression in Python and allow yourselves the flexibility to like minimize your error rates and actually save the company a lot of money if you know how to leverage these tools really well. So finding our team experiment a ton more. And I think a lot of it also has to, come from me to be able to show people that, that's the way I want to operate too. So I think it's a fun time to be operating in a finance or ops role because, these tools have very much democratized who can have a good idea.
You strike me as a guy who likes to build a lot of shit.
Yeah, I mean, my team knows if they don't send me the spreadsheet or backup of something, it's like the first question I'll ask.
Have you had like a WTF moment yet with like Claude as like an Excel plugin or any, like, just take me into some analysis you did lately and you're like, holy shit, I can't believe I can do that.
We have these agreements with all different sets of frontier models because, we service them in our products in, a whole bunch of different ways. And in order to unlock better pricing or, access to provision throughput or lower latency, you need to be able to step up and commit in order to do that. And so having the ability to forecast what is like a need that's obviously going to vary as users are going to come in and use your tool at different times of day. You're basically buying a parking lot and have a whole bunch of unused spaces, and you want to make sure that you're minimizing the amount of unused spaces. And so it's actually kind of interesting to be able to build a model there that is optimized for what is the cost of it if I commit ahead, what is the on-demand rate, how does that actually potentially translate to a lower number of errors. So there isn't like a perfect answer, but at least like you can very clearly see and articulate what are you optimizing for and what are you comfortable sitting on.
Last one I got for you. What's the craziest thing you've ever had someone try to expense?
I mean, we've got our fair share of like fun dinners and, hockey games. And the funniest one probably is like, I had a pretty tight grip on expenses and I felt so bad. We had just rolled out credit cards to a whole bunch of folks in the company. One of our, early design leaders, he had expensed a really expensive haircut on his corporate card because he realized that he just didn't have another one. And he like came to me tongue in cheek with a, I think it was like $150 check. I was like, what barber did you go to? But that was, definitely put a smile on my face.
What did Deion Sanders say? Look good, feel good, play good, right? Praveer, thank you so much for making time for me. Like I said, this is a bucket list interview and I'm a huge fan of everything you built.
Yeah, thanks for having me. It's a lot of fun.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.